On April 22nd, 2026, the FDIC released its latest risk review. Every page of that report describes a banking system carrying stress far beyond what most depositors ever see. The industry is still holding $306 billion in unrealized losses tied to securities portfolios. These are paper losses connected to bonds purchased during the low-yield era, assets that dropped in value after interest rates climbed. The FDIC identified commercial real estate as the leading credit threat inside the system. Office vacancies remain elevated, operating expenses continue rising. Many borrowers cannot refinance debt at current interest rates, pushing banks to rely on loan modifications instead of formally recognizing losses. Consumer lending pressure is also increasing. Delinquencies on auto loans and credit cards are now running above levels seen before the pandemic. The banking failure cycle that began with the collapse of Silicon Valley Bank during 2023 recorded its first victim of 2026 in January. Banks are earning between 3% and 4% on customer deposits, while many savers receive only 0.01% in return. That spread remains one of the core profit engines of the banking industry. At the same time, deposit products exist that pay between 4% and 5%, while still remaining under FDIC insurance coverage limits. The figure that matters most in the FDIC report is the $306 billion unrealized loss total, because it directly connects the condition of bank balance sheets to depositor confidence. An unrealized loss appears when a bank purchases a bond or security at one price, and the market value later falls below the original purchase amount. The loss stays unrealized because the institution has not sold the asset. Instead, the security remains on the books at the original valuation, while the market decline is tracked separately. That distinction became critical during March of 2023 when Silicon Valley Bank failed. The bank had built an enormous portfolio of long-duration treasury bonds and mortgage-backed securities during the zero interest rate period. Once rates surged through 2022 and 2023, the market value of those holdings collapsed. The unrealized losses at the bank exceeded its equity base. After depositors became aware of the situation, the institution suffered the fastest modern bank run in American history. Operations unraveled within 48 hours. The FDIC, the Treasury Department, and the Federal Reserve carried out an emergency weekend intervention designed to stop contagion from spreading across the regional banking sector. According to the FDIC review, unrealized losses throughout the banking system peaked above $500 billion during the 2022 through 2023 period. By the fourth quarter of 2025, the number had declined to $306 billion. That 36% reduction reflected the impact of Federal Reserve rate cuts introduced during late 2024 and throughout 2025. Falling rates lifted bond prices and reduced paper losses across bank portfolios. Still, the $306 billion figure remains the highest unrealized loss level recorded since early 2022. Before the Silicon Valley Bank collapse began, the language used by the FDIC is direct. Unrealized losses remain elevated compared with historical norms. Conditions have improved from the worst phase of the crisis, but they have not returned to standards seen before 2020. Commercial real estate remains the most active and unresolved area of credit stress identified in the review. That sector includes office towers, retail space, apartment buildings, hotels, and industrial facilities. Pressure has been building since 2020, when remote work sharply reduced office occupancy rates. Higher interest rates then pushed refinancing costs dramatically upward. The FDIC identified three specific drivers behind the continuing commercial real estate strain. First, elevated vacancies and higher operating costs are weakening borrowers' ability to continue servicing debt obligations. Second, when commercial real estate loans mature, refinancing now requires much more expensive borrowing terms than the original agreements. Many property owners cannot absorb those costs at current valuations. Third, banks are increasingly modifying loans instead of forcing defaults. Institutions are extending maturities, adjusting payment schedules, and waiving covenant requirements to provide temporary relief. Analysts have compared this process to the extend and pretend approach seen in private credit markets. The strategy delays recognition of losses without fixing the underlying deterioration. The FDIC supervises 3,960 insured banking institutions. Banks carrying heavy concentrations of commercial real estate exposure are now under heightened supervisory attention. The concern is not that commercial real estate losses will destroy the entire banking system. Industry capital ratios remain strong. Return on assets reached 1.20% during 2025, while total net income reached $295.6 billion. The real danger is concentrated weakness. Certain institutions hold a combination of heavy commercial real estate exposure, elevated unrealized losses, and unusually high dependence on uninsured deposits. That mix mirrors the same pressures that contributed to the failure of Silicon Valley Bank. The FDIC also maintains a confidential problem bank list. Institutions on that list receive ratings of 4 or 5 under the agency's internal CAMEL supervisory system, indicating severe financial weakness. On January 30th, 2026, the Illinois Department of Financial and Professional Regulation closed Metropolitan Capital Bank and Trust in Chicago. The FDIC assumed control of the institution and estimated the cost to the Deposit Insurance Fund at $19.7 million. As of September 2025, the failed institution reported total assets of $261 million, while liabilities had expanded to $257 million. The margin protecting the bank's solvency had become extremely thin, and the institution ultimately failed once it could no longer satisfy its obligations. First, Independence Bank, based in Michigan, agreed to purchase the failed bank's assets. Depositors at Metropolitan Capital Bank and Trust received immediate access to insured funds because FDIC coverage protected accounts up to $250,000 per depositor. Every dollar below that threshold remained secure. Customers holding balances above the insured limit faced a very different situation. That is why the $250,000 cap per depositor per institution carries major importance for anyone keeping concentrated cash reserves in one bank. Only 2 banks failed during all of 2025. By contrast, 2026 recorded its first collapse before January had even ended. Analysts viewed that development as a meaningful statistical signal. One financial review examining the closure concluded that this likely would not be the final bank failure of 2026. Just 3 months after that first shutdown, the FDIC released its own risk review identifying several simultaneous pressure points across the financial system. Commercial real estate stress remained active. Unrealized losses stayed elevated. Consumer delinquencies continued rising. Indirect liquidity threats linked to the non-bank sector also remained under watch. Individually, none of these issues were described as catastrophic. The FDIC clearly stated that the banking industry still maintained solid capital positions and adequate liquidity overall. The concern comes from concentration. Certain institutions, certain regions, and certain categories of loans are carrying combined pressures that differ sharply from the relatively calm environment that existed before the regional banking turmoil of 2023. Another figure now stands out for American savers. According to FDIC national rate data, the average savings account rate at traditional banks during May of 2026 was 0.01%. JP Morgan Chase paid 0.01%. Bank of America also paid 0.01%. Wells Fargo matched the same rate. These 3 institutions represent the largest banks in the United States and collectively control trillions of dollars belonging to American households. Yet depositors are effectively earning 1 penny annually for every $100 sitting in a standard savings account. At the same moment, online banks offering FDIC-insured high-yield savings products were paying between 4.0% and 5.0% per year. Those accounts carry the exact same federal insurance structure. Coverage remains protected up to $250,000 per depositor through the full backing of the United States government. There is no additional insurance gap. Liquidity differences are also minimal. Transfers between checking accounts and high-yield savings accounts generally settle within 1 to 2 business days. The primary distinction is which institution keeps the interest spread generated by deposited funds. At 0.01%, most of the benefit remains with the bank itself. At 4.5%, depositors keep the majority of that return. For someone holding $50,000 in savings, the yearly difference between earning 0.01% and 4.5% equals $2,245 in cash every year. Inside a fully insured account, the payment does not depend on market exposure or investment risk. It is simply contractual interest earned on money that has already been saved and intentionally kept liquid. The issue is not whether high-yield accounts introduce additional danger. The issue is why $2,245 in annual risk-free interest may still be sitting unclaimed inside a traditional bank account. The timing behind current interest rates also matters. The Federal Reserve kept rates between 3.50% and 3.75% through its latest FOMC meeting. Kevin Walsh, recently confirmed as Federal Reserve Chair, arrived with a documented hawkish policy history while inheriting an economy where inflation was running at 3.8%. Market expectations for rate cuts during 2026 have now shifted much later than analysts originally forecast at the beginning of the year. Whenever expectations for cuts move further into the future, high-yield savings rates generally remain elevated for longer periods. There's also a timing factor connected specifically to Friday. Many high-yield savings accounts and promotional certificate of deposit offers advertised rates that can change at any moment. Banks adjust those rates in response to Federal Reserve guidance, Treasury yield movements, and competition shifts that can occur within days after major economic releases or policy communication. The May 2026 CPI report scheduled for release this week has become one of the most closely monitored inflation readings in years. If the data shows that April's 3.8% inflation rate accelerated further, expectations for delayed rate cuts would likely strengthen, creating a more favorable environment for savers. If inflation instead comes in weaker than expected, some institutions may begin reducing advertised savings rates in anticipation of future Federal Reserve easing. Banks that move first often make those adjustments quietly, sometimes on a Thursday night before most customers have compared updated rates. Moving funds before that data arrives, before Friday, locks in rates available during the highest yield savings environment seen since 2007. The mechanics of moving money safely matter just as much as the decision itself. The most important principle is understanding how FDIC insurance coverage works. The FDIC protects deposits up to $250,000 per depositor, per insured institution, and per ownership category. That means a married couple can maintain coverage of up to $500,000 at one FDIC-insured bank through a joint account structure calculated as $250,000 for each individual, with additional protection available through separate individual accounts held at the same institution. Adding beneficiaries through payable-on-death account designations can expand FDIC protection even further. Each named beneficiary increases coverage by up to $250,000 per account. The FDIC also provides a free electronic deposit insurance estimator through its official website at fdic.gov. That tool calculates exact protection levels based on the structure of an account. For Americans holding more than $250,000 in savings, including proceeds from home sales, inheritance money, or accumulated retirement funds, dividing deposits among multiple FDIC-insured institutions remains the simplest and most effective protection method. As of May 2026, the market for high-yield savings accounts has become more competitive than at any time in decades. Several FDIC-insured online banks and credit unions are currently paying between 4.0% and 5.0% APY on savings accounts that require no minimum balance and charge no fees. The accounts attracting the most attention are those using variable APY structures. These rates move with the broader interest rate environment rather than operating as temporary promotional offers that later fall back to lower baseline yields. E-Trade Premium Savings accounts are presently advertising a boosted 4% APY for 6 months on new accounts opened before June 9th, 2026. SoFi Bank is offering 3.3% APY for customers meeting eligible direct deposit requirements. Multiple additional institutions remain in the 4% to 4.5% range, using standard high-yield savings structures without promotional expiration dates. The difference between a temporary promotional rate and a standard variable rate account depends entirely on how long the depositor intends to keep funds inside the account. Long-term balances and short-term cash management strategies require different approaches. Certificates of deposit also present another opportunity. CDs provide fixed rates for predetermined periods ranging from 3 months up to 5 years. Because the rate is locked at the time the account opens, CDs shield savers from future rate cuts that could reduce returns on variable high-yield savings accounts. If Kevin Walsh and the new FOMC eventually lower rates during late 2026 or early 2027, as futures markets still broadly expect, CD holders securing 4.5% to 5% terms this week would continue receiving those yields for the full duration of the contract, regardless of Federal Reserve actions. A 1-year CD opened this week at 4.5% would generate $2,250 on a $50,000 deposit. That return remains guaranteed whether rates fall by 50 basis points, 100 basis points, or remain unchanged. A 2-year CD offering comparable yields extends that certainty across 24 months. The FDIC insures CDs under the same $250,000 per depositor, per institution limits applied to regular savings accounts. The trade-off between a CD and a high-yield savings account is liquidity. Most CDs impose early withdrawal penalties that reduce earned interest if funds are accessed before maturity. A common strategy called laddering addresses that issue. Depositors split savings among several CDs with staggered maturity dates so that portions of the portfolio become available every 3 to 6 months. The FDIC's 2026 risk review also identified another developing concern inside the banking system involving lending tied to non-bank financial institutions. The report specifically warned that private credit funds, hedge funds, and similar entities facing margin calls or redemption pressure could rapidly draw down bank-funded credit lines at the same time. That scenario could create a sudden liquidity drain for banks. Stress inside the private credit market would then translate directly onto bank balance sheets. Banks that extended large credit facilities to private credit funds face the possibility that those lines could be tapped with very little notice, reducing liquidity through forces outside the bank's direct control. The FDIC stated that this area requires continued vigilance alongside elevated commercial real estate pressure, $306 billion in unrealized securities losses, increasing consumer delinquencies, and the demonstrated reality that a bank in Chicago failed before January 2026 had ended. For depositors across the United States, the current environment is not existential. But it is also not neutral. The appropriate response is not panic. It is optimization. Funds above $250,000 should be distributed across multiple FDIC-insured institutions. Savings earning 0.01% at traditional banks can be transferred into FDIC-insured high-yield accounts, paying between 4% and 5%. Cash intended to remain liquid for 6 to 24 months should also be evaluated for CD rate locking before expected rate cuts eventually become reality. Scott Bessent and the FDIC both continue projecting overall banking stability based on strong capital ratios and improving net interest margins. The banking system is not facing collapse. However, the difference between 0.01% at a large traditional bank and 4.5% at an FDIC-insured online institution represents thousands of dollars in lost annual interest for the average American household. That gap exists without additional risk, without weaker insurance protection, and without requiring investment in anything beyond federally insured deposit accounts. The urgency surrounding Friday remains real. CPI data arrives this week. Expectations for future rates can shift within hours after the release. Institutions currently advertising 4.5% to 5% yields may reduce those rates before the weekend begins. Right now, that window remains open. Every day that $50,000 stays parked at 0.01%, instead of 4.5%, costs approximately $6 in lost interest. At first glance, that number appears small. Across a full year, it becomes $2,245. The money already belongs to the depositor. Moving it online takes roughly 20 minutes. If this information helped clarify how the current banking environment affects savings decisions, share it with someone still leaving cash in a traditional account, earning nearly 0% interest. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.